Okay, let's unpack this. How often are we truly fooled by randomness? And maybe more importantly, what does that actually mean for how we make decisions, especially, when money's on the line? Today, our deep dive is all about navigating that very question. We're drawing deep insights from Nassim Taleb's fantastic book, Food by Randomness. Our mission really is to pull out the most important nuggets of knowledge, things that help you understand the real-world impact of probability and, well, luck.
And that's so crucial because, as Taleb really masterfully points out, understanding probability
Yeah.
it's surprisingly difficult.
Even for the experts.
Oh, absolutely.
Mm.
Even for people with advanced degrees, maybe in applied math or statistics, few truly grasp it theoretically. And honestly, even fewer get its practical implications.
Mm.
You see this vulnerability play out all the time, dramatically, in financial markets.
Yeah.
They're just prime examples of where people are constantly being misled by randomness.
So, when we talk about being fooled by randomness, what's maybe one of the most common ways, the kind of insidious ways it traps us, especially when we're trying to learn from other people's success?
Well, a big one Taleb highlights is survivorship bias.
Survivorship bias.
It's this tendency we have to focus only on the survivors, the successful ones, and completely ignore the huge number of failures, the ones that never made it into the spotlight.
Okay,
Let me give you a pretty striking example right from the sources we looked at.
I'm ready. Lay it on me.
Okay, imagine a 22-year-old. Let's call him Fenn Sensen. And he's already amassed a fortune of $3 million.
Wow, 22. Okay, impressive.
Very impressive, right? You probably want to ask him for investment advice.
Definitely.
But here's the twist. Sven got his fortune playing Russian roulette.
Oh, what?
Yes. With the Swedish mafia, apparently. On 3 separate occasions, each time betting $1 million.
Okay, hold on. Russian roulette. So he's just incredibly lucky to even be alive, let alone rich.
Exactly. The statistical reality is pretty stark. In something like 32% of other possible realities, Sven died before he even turned 23.
Wow. Okay, so the real danger there isn't just Sven's, well, sheer stupidity,
Right.
but our tendency to ignore all those unseen failures, the Svens who didn't make it. How does that sort of blindness play out in markets?
Precisely. Because what happens next? Sven might start offering bulletproof advice.
Oh, no.
Yeah. He'd tell other young people, oh, it's not as dangerous as it seems. The trick is, just blink 3 times as hard as you can, then clap before you pull the trigger. Trust me, it's bulletproof.
And people would listen because he's the guy who survived and got rich.
Exactly. Young people might admire Sven for his supposed skills and try his strategy, thinking it's genuinely effective. They completely overlook that 42% chance he didn't make it. It's just a classic, almost textbook case of survivorship bias.
It's frighteningly easy to fall for that, isn't it? Let's take another example, maybe a bit more relatable. Martin the monkey.
Yes, Martin.
So Martin, he's throwing darts at stock listings, specifically the OMXS 30 index, that's the 30 biggest Swedish companies. He does this on January 1st, 2018, picks 3 companies.
Okay. Dart-throwing monkey. Got it.
Right. Fast forward a year. Today, his return is an impressive 12%.
12%? That's pretty good.
It's really good, especially considering the overall OMXS 30 index was actually down by about 10% that year.
Wow. Okay. So he beat the market significantly.
Totally. And Martin, he's incredibly proud. He's telling all his monkey friends about his brilliant stock picking strategy.
Naturally.
It involves, apparently, precise dirt velocity, advantageous spin, and even what kind of food they should eat the day before throwing.
Huh. So the secret is bananas, maybe.
Maybe. So if my returns aren't great, maybe I just need to adjust my pre-throwing snacks.
Well, that's certainly one theory. But what's truly fascinating here, and this gets back to the bias, is that neither we as observers nor Martin himself really consider the other possible outcomes.
What do you mean?
Well, what if, instead of hitting Ericsson with his first dart, he'd hit SKF, a different company? Then his return could easily have been, say, minus 12% instead of plus 12%.
Ah, right, the counterfactuals.
Exactly. The issue, because of survivorship bias, is we never hear about the Martins who missed Ericsson and hit SKF instead.
Right.
Only the highest performing realizations, the luckiest outcomes, they're always the most visible.
It's almost like the media only ever covers the lottery winners, doesn't it? You never see headlines about the millions who bought tickets and lost.
Precisely.
The book, How I Lost 12% Investing in a Market That Declined 10%. That's never going to make it to the bookstore shelf.
Never.
But how I made 12% in a market that declined 10%, that might just become the next bestseller.
Absolutely. And this really raises an important question for you, the listener, to consider.
Hmm.
What does this all mean for judging success or skill? For 2018, when you pick 3 stocks randomly from the OMXS30, the expected return was actually around minus 10%. That was the average outcome.
Yeah.
And there was a standard deviation of about 11%, which basically means a wide range of outcomes around that average was entirely normal, even for pure chance.
So Martin's 12%.
It implies that purely by chance, out of maybe 40 monkeys throwing darts, one of them would have gotten Martin's return, or even better.
Just by luck.
Just by luck. Now,
Yeah.
scale that up. If there are, say, 2,000 monkeys out there throwing darts at stocks,
Okay.
then maybe 50 of them would have had a return of 12% or better, purely by chance. And you can bet one of them will definitely write a book about their genius strategy.
Right. We attribute skill where, pure randomness is really the driving force.
Exactly.
That idea of expectation versus just pure probability. It really twists my brain a bit. What's the next big concept Taleb unpacks that ties into this whole understanding of risk?
Yeah, it leads us directly into something Taleb calls the skewness issue.
Skewness issue.
Well,
Okay.
He talks about his own experience. He was a trader at a large New York investment house, and he was in a meeting with company stakeholders. They asked his opinion on the stock market.
Standard question for a trader.
Right. And he told them, look, I think the market is likely to go up this week, probably a 70% chance it goes up.
Okay, so he's bullish, right? Sounds bullish.
That's what they thought, too. But then someone interrupted him. Mr. Taleb, they said, hang on. I just saw you taking a huge short position in S&P 500 futures. What made you change your mind?
Uh-oh.
Yeah, the room was just utterly confused. They said, Mr. Taleb, I don't understand. Are you bullish?
Yeah.
Or are you bearish?
Yeah, I'd be confused too. He's predicting an upward move, but he's betting on a downward one. How does that make sense?
Well, Taleb explained that he didn't understand their question.
Okay.
He was bullish in the sense of which direction he thought the market was most likely to go, the 70% chance. But, he argued, it was still preferable to short the market because in the less likely event, the 30% chance the market went down, Taleb expected a much, much larger move in that direction.
Ah, okay. So the potential loss was bigger than the potential gain, even if the gain was more likely.
Sort of, but think magnitude. People, in general, confuse probability, just how likely something is, and expectation. Expectation is the probability multiplied by the payoff or the loss.
Right. Probability times magnitude.
Exactly. People often seek high probability. They want to be right often, even if the payoff for being right isn't actually that great, or the loss from being wrong is huge.
Okay, can you give an example?
Sure, let me give you a clear hypothetical stock example. Imagine a stock. There's a 90% chance it goes down 10%.
Okay, 90% chance I lose 10%. Doesn't sound good.
And there's a 10% chance it goes up 200%.
10% chance it triples, basically.
Right, so 90% chance of losing 10%, 10% chance of gaining 200%. Would you buy it?
90% chance of losing money. My immediate reaction says, no way.
And yet, mathematically, you should want to buy it.
Really? Why?
Because on average, such a stock will yield 11% on your capital. The expectation is positive. You calculate it. 0.90 number 10% plus 0.10 plus 200% plus 20% plus 11%.
Wow, that's fascinating. A 90% chance of losing money, yet it's technically a buy. Why do you think so many people, maybe even sophisticated investors, shy away from bets like that? Is it just emotional, or is there something deeper about how we perceive winning and losing?
I think it's a powerful combination. Emotionally, yeah, it hurts a lot being wrong 90% of the time.
Sure does.
We're kind of wired for frequent positive reinforcement, right?
Right.
We dislike losing, even small amounts, repeatedly. Even if those occasional huge wins theoretically compensate over the long run.
Okay.
And maybe deeper than that, people just really struggle with the concept that a high probability event might have a low payoff, while a really low probability event could have an astronomical one. We default to thinking about the probability, the likelihood, not the expectation, the average outcome.
So Taleb's approach really challenges our natural tendency, our inclination towards seeking consistent, frequent wins. What's the biggest hurdle, do you think, for people to actually adopt that bleed some frequently mindset and practice?
Precisely. Nassim Taleb loves to take advantage of this skewness issue in his trading. One of his main strategies is, as you said, bleed some frequently. That means he accepts small, frequent losses. But the key is he ensures he never experiences a cutthroat, devastating loss, a blow-up.
Right. Protect the downside.
Always. And then every winning bet, That's a home run, a massive gain.
So the asymmetry is key.
Absolutely. The biggest hurdle to doing that, it's certainly psychological. Enduring many small losses requires incredible discipline. It requires a strong understanding of your strategy's underlying math, its positive expectation, not just going with your gut feeling day to day.
That's a really powerful way to think about managing risk. And speaking of, unexpected events and big risks, let's dive into the Black Swan problem.
Ah, the Black Swan, yes.
Let me pose a provocative statement, maybe something you might hear. The stock market, let's say the Dow Jones Industrial Average, has never been down more than 23% during one single day. Not in its entire history, like 44,000 days of existence. Therefore, it can't go down more than 23% in a single day. True or false?
Well, of course, that statement is false.
Right. Why?
Imagine someone making a very similar argument back on, say, the 18th of October in 1987.
Okay.
They might have said, look, the stock market can't go down more than, say, 30% in a single day, because it has never done so during its entire 33,000 days of existence up to this point.
Makes sense, based on the data they had then.
Right. But that person would have been proven spectacularly, painfully wrong the very next day. October 19th, 1987, Black Monday. The Dow Jones Industrial Average crashed by 22.6% in a single day.
Wow. Almost hit that 23% mark we started with.
Almost. And this is what Taleb refers to as the Black Swan problem.
Okay. Explain the analogy.
The classic analogy is this. You can observe millions of white swans, but no amount of observing white swans can ever logically allow you to conclude that all swans are white.
Right. Because
the observation of just a single black swan is sufficient to completely refute that conclusion.
Okay, I see. So one outlier event invalidates the rule derived from past observations.
Exactly. And if we connect this to the bigger picture, the implication is profound. It means that historical data, while valuable, can never, ever fully predict the truly unprecedented events, the black swans.
The true insight from a black swan isn't just be careful. I think Taleb would argue it's about building anti-fragility into your decision.
That's a great point. Yeah.
It means accepting that the most impactful events are often precisely the ones history can't predict, which forces us to prepare for the unpredictable rather than just trying to fine-tune predictions based on the past.
Absolutely. It's about robustness against the unknown.
So for you as a listener, the takeaway is always be careful, extremely careful, when relying on statements like, the market has never done this before in your investing approach. History gives us patterns, sure, but it absolutely does not guarantee the future won't bring something completely new.
Well said.
Now, okay, all of these concepts, survivorship bias, skewness, black swans, they can paint a pretty pessimistic view of investing, can't they? It might feel like the odds are just stacked against you, that it's all random chaos.
You can't feel that way, yeah.
But Nassim Taleb offers a kind of powerful counter, an approach he frames using Pascal's wager for investors.
Right. So the philosopher Pascal's original wager, just briefly, was about belief in God. He argued the optimal strategy for humans is to believe in God.
Why?
Because if God exists, the believer gets an infinite reward, basically. And if God doesn't exist, the believer hasn't really lost much, maybe just followed some rules they didn't need to. So the upside is huge, downside limited.
Okay, the logic makes sense. How does Taleb adapt that to trading or investing?
Well, Taleb adapts this reasoning like this. If historical data suggests a particular strategy or pattern seems to be successful, you should probably try to use that to your advantage. Why not?
Okay.
If the historical data does reveal real opportunities for the future, great, you'll be rewarded. And if it turns out that historical pattern doesn't hold or doesn't reveal anything useful, well, you'll probably just end up returning the market average anyway. You haven't lost much by trying the strategy, assuming you managed risk.
Okay. But there's a crucial caveat, isn't there, about risk?
Yes, exactly. The crucial caveat is use historical data to look for potential opportunities, potential positive skewness. But, and this is the big but, don't use historical data, especially things like volatility or maximum drawdowns from the past, to decide your risk exposure. Don't use it to decide how much you should bet.
Why not?
Because of the black swan problem. History doesn't tell you the worst possible outcome, only the worst outcome observed so far. Relying on past volatility to set your risk level makes you incredibly vulnerable to an unprecedented event.
I see. So the real genius, maybe, of Taleb's Pascal's wager for investors is it allows you to intelligently speculate on historical patterns for potential upside.
Right.
While fiercely protecting your downside from the very same historical data that inspired the bet in the first place. It's like separating the opportunity signal from the risk signal.
That's a great way to put it, yes. It's about using history for ideas, but not for safety limits.
So you gain the potential benefits of a strategy you've noticed worked in the past, but you avoid the huge risk of overestimating its accuracy or underestimating future volatility and potentially overexposing yourself. It sounds almost too good to be true, but it makes logical sense.
It requires discipline, but the logic holds.
Okay. So wrapping this towards practical application, what does this all mean for you, the listener? How do we apply these insights day to day? Taleb outlines what he calls the 5 traits of the market fool, common pitfalls to identify and, crucially, avoid.
Right, let's go through them. The first trait is overestimating the accuracy of beliefs.
Okay, like what?
This includes being overconfident about historical data, maybe in an economic forecast or a statistical measure of risk. It's dangerous for all the reasons we've discussed. Black swans, data reliability issues, the market environment changing, maybe just overfitting your model to past data.
Your model is just a model, not reality itself.
Exactly. That's trait number one. Second, the market fool has a tendency to get married to their positions.
Ah, the emotional attachment.
Yes. There's that old saying, traders divorce spouses before positions.
Ouch.
It sounds harsh, but there's truth to it. I've certainly fallen into that trap myself early in my career. It's just amazing how emotionally attached you can become to an investment, even when all the objective data is screaming, get out. This attachment can truly blind you.
Been there. Okay, what's number 3?
Third, the market fool changes their story.
How so?
They suddenly become a long-term investor only when they start losing money on a short-term trade.
Right, the classic justification.
Yeah. They rationalize, oh, it's down. Well, now it's even better value. But they never stop to consider that maybe their initial way of determining value was flawed from the start. They just shift the goalposts to avoid admitting a mistake.
Okay. Number 4.
Fourth, they have no plan for how to take losses.
Because they don't expect to lose.
Pretty much. Because they don't seriously consider the possibility they could lose money when they put on a trade. They don't have a game plan, no predefined exit strategy for when things go wrong. Which is why Taleb and many successful traders stress.
Yeah.
Always predefine your risk. Before you even enter a position, know exactly what will make you get out if it goes south.
Makes sense. Have your stop loss in mind, mentally or physically.
Absolutely. And finally, fifth, the market fool is in denial.
Denial about what?
Denial about their own role in the outcome. Once they finally accept their losses, which is usually way, way too late, they refuse to believe it was their own fault, their analysis was wrong, or their timing was bad. No, they were simply unlucky.
Back to randomness.
Exactly. It's quite striking, because when they earn money, remember Morton the monkey from earlier?
Yeah, his amazing dart-throwing skill.
Right. When they profit, they attribute it all to their brilliant skill. But in the eyes of the market fool, losses always happen due to randomness, bad luck, while profits always come thanks to their own genius skills.
That's a profound observation about human psychology, isn't it? That asymmetry in attributing outcomes, it really forces us to check our own biases.
It really does.
Okay, so to quickly recap our journey through Taleb's insights from Fooled by Randomness. First, be really careful when judging someone's performance based purely on their results. You have to consider the alternative outcomes, the unseen failures, to avoid survivorship bias.
Right.
Second, don't confuse probability and expectation. Aim to maximize your expected profit over time, not just the probability of being right on any single bet. Understand that skewness matters. Third, be deeply aware that a black swan, a totally unprecedented event, might always be lurking around the corner.
Right.
You need to build in robust preparation for the unexpected, not just rely on past data for safety.
Absolutely.
Fourth, use historical data maybe to inform your investing approach. Look for ideas, but be incredibly careful, almost paranoid, about letting past data dictate your risk exposure. Use Pascal's wager wisely.
Yes.
And finally, try hard to avoid those 5 pitfalls of the market fool. Avoid overconfidence in your beliefs and models. Don't get emotionally married to your positions. Don't change your story midstream to justify losses. Always invest with a predefined exit plan for losses. And never deny the fundamental role of luck and randomness in both your profits and your losses.
That's a great summary. And maybe this raises one last important question for you, the listener, to consider.
Yeah.
If so much of what we perceive as skill, especially in fields like finance, is merely the visible tip of a huge mountain of random outcomes, well, how does that change your approach to decision-making? Not just in finance, maybe, but in life. Perhaps true intelligence, or maybe wisdom, lies not so much in trying to predict the future perfectly, because we can't. But maybe it lies in robustly preparing for multiple possible futures, in embracing that uncertainty rather than denying it.
That's a fantastic thought to leave everyone with. Preparing for multiple futures, embracing uncertainty. These insights from Fooled by Randomness, they really do challenge how we perceive success, failure, and the huge role of chance in our lives. We definitely recommend you dive deeper into Nassim Taleb's work if your curiosity has been piqued. Thanks for joining us for this deep dive.